Hey everyone, welcome back to Corporate Decoder. Today, ALTS just filed an 8K report detailing significant acquisition activity, and I am seeing a multi-pronged strategy that could rapidly reshape the company. Quick note, this is not financial advice, just my take on public filings for educational purposes. ALT5 Sigma is making bold moves by acquiring two companies and issuing a massive amount of stock, which could be a game changer or a dilution nightmare. Alright, let's dive into what ALT5 Sigma Corporation has been up to. They've filed a current report, which means something material has happened, and in this case, it is big news. The key date here is the 20th of April 2026. This is when the company announced a couple of major deals. ALT5 Sigma Corporation, trading under the ticker ALTS, is involved in technology and software applications. We've seen some recent headlines around strategic acquisitions and new leadership appointments, which sets the stage for this filing, with a market cap of around $110 million and a small team of 15 employees. These acquisitions are significant for a company of their size. The report details two main agreements. The first is with Block Street Corp. ALT5 Sigma entered into a stock exchange agreement with the four owners of Block Street Corp. What does this mean in simple terms? They are essentially acquiring Block Street. As part of this deal, Alabama T5 Sigma issued a significant amount of their common stock to these owners, totaling 1,267,0257 shares. This is a pretty substantial chunk of equity. They also granted warrants to purchase more shares, and two of the Block Street owners will be joining ALT5 Sigma in employment roles. They valued these newly issued shares at $12 million based on the Nasdaq minimum price. On top of that, they've issued two sets of warrants. The first set, called Set One Warrants, is exercisable for up to 15837,821 shares of common stock with an initial exercise price of $15 million. The second set, Set Two Warrants, is for up to 168,93675 shares with an initial exercise price of $16 million. Now, these warrants have a remaining exercise price of just a fraction of a cent, which means if the company does well, these warrant holders can convert them into many more shares. The interesting part about these warrants is that they have performance-based vesting clauses. For the Set One Warrants to become fully active, Block Street, after becoming part of ALT5 Sigma, needs to generate at least $20 million in net revenues over 4 consecutive quarters. For the Set Two Warrants, the trigger is generating at least $8 million in modified operating income, annually also over 4 consecutive quarters. They've defined modified operating income as net operating income plus realized gains and minus realized losses from token sales related to Block Street's cryptocurrency operations. This is a crucial detail. They are linking a significant portion of their potential future equity dilution to the actual performance of the acquired business, specifically within the crypto space. Now, when a company issues a lot of stock and warrants, a key concern for existing shareholders is dilution and the potential for a flood of shares hitting the market. ALT5 Sigma seems aware of this. The shares issued to the Block Street owners, as well as the shares underlying the warrants, are subject to lockup and leak out provisions. The lockup period is 24 months, with gradual releases of 25% every 6 months. The leak out provisions are quite detailed. They limit how much stock these holders can sell on any given day, tying it to a percentage of the average trading volume over the previous 20 days. This is designed to prevent a sudden dump of shares that could crash the stock price. They also have to sell at the best bid price. If they transfer shares to a third party, that third party must also agree to similar leak-out terms, and their sales will be aggregated with the original holder. It is important to note that these issuances were done as private offerings, meaning they were not registered with the SEC in the typical way. This is common in acquisitions and venture deals. The second major deal is with Decentralized Technologies Inc., or DecTech. ALT5 Sigma has entered into a binding letter of intent to acquire DecTech. Again, they are issuing stock for this deal. They will issue an initial 4 million shares of their common stock to DecTech's equity holders. Beyond the initial issuance, there is a potential for up to another 4 million shares to be issued over the next 36 months. This additional issuance is tied to DecTech generating $5 million in gross profit for every 1 million shares issued. Gross profit here is defined as gross sales from DecTech solutions minus various direct and operating expenses. This is another performance-based component, aiming to ensure that the stock issued is justified by the actual financial performance of the acquired company. This section essentially confirms that the shares issued in these transactions were unregistered, as we discussed earlier. The filing also lists the exhibits, which would include the actual agreements for the stock exchange agreement, employment agreements, and the warrants. We see here the specific forms of the warrants granted in the Block Street transaction, and the stock exchange agreement itself. These are the foundational documents laying out the terms of these significant acquisitions. Finally, the report is signed by Tony Isaac, the Chief Executive Officer and President of ALT5 Sigma Corporation, dated the 24th of April 2026. This confirms the company's awareness and approval of these transactions. Now let's tie this all together and look at what this means for ALT5 Sigma. This filing reveals a company that is not just growing organically, but is actively pursuing inorganic growth through acquisitions. They are acquiring Block Street Corp and entering into a letter of intent to acquire Decoder. The strategy seems to be focused on expanding their technological capabilities and market reach, especially with mentions of cryptocurrency operations and decentralized technologies. A major point to consider is the sheer amount of equity being issued. For the Block Street deal alone, they are issuing over 12.6 million shares initially, with potential for nearly 33 million more shares to be issued if all warrants are exercised. Then for Decoder, it is an initial 4 million shares with another potential 4 million shares. This is a significant increase in the total number of shares outstanding. While the performance-based triggers for warrants and additional Decoder shares are good for managing dilution risk, it means a lot of future stock could flood the market if these companies perform exceptionally well. The market has reacted positively to such strategic moves in the past, as indicated by recent headlines about ALT5 Sigma announcing strategic acquisitions and new leadership. Tony Isaac being appointed CEO and receiving a significant equity award also suggests strong leadership alignment with shareholder value. However, the success of these acquisitions hinges entirely on the performance of Block Street and Decoder. If they don't hit their revenue and profit targets, the additional stock issuances won't happen. But the initial dilution is already significant. For existing shareholders, the lockup and leak out provisions are crucial. They are designed to protect the stock price from immediate sell-offs. The daily leak out volume limits, tied to trading volume, are a standard but effective way to manage the supply of newly available shares. However, with so many shares potentially becoming available over time, sustained positive performance and growth from the acquired entities will be absolutely critical to absorb this supply and drive the stock price higher. One risk I am watching is the integration of these new entities and the effective management of their operations, particularly within the complex and often volatile cryptocurrency space. The company's small employee base of 15 might face challenges in managing these expanded operations effectively. My biggest concern is whether the projected revenues and profits will materialize as expected and if they can truly justify the significant equity dilution. What I am actually looking for is a clear path to profitability and sustainable growth that outpaces the dilution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.